Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today, we are in another week of Commercial Real Estate Month. Today, we're speaking with Jason Muss, who joined Muss Development LLC and is a president of the firm. He's an active member of the Real Estate Board of New York and the Brooklyn Chamber of Commerce and is the vice chair of AIPAC's New York Real Estate Division. He got his bachelor's degree from Yeshiva University and his JD from NYU. Welcome to the podcast, Jason.
Thank you, Rob. Appreciate it.
So this month we're obviously doing commercial real estate. We've had a very, very New York focused thing, and your geography, so to speak, is all up and down the East Coast. So can you give us a flavor of where you see values there and what's cooking and interesting outside of the New York City megalopolis?
Well, I think the East Coast is unique in that there's access to a tremendous amount of people, no matter where you go. Anywhere on the East Coast is within a few hours of anywhere else on the East Coast,
Right.
From Florida to Maine. I think that that's always been a strength. Obviously, once you get into the middle of the country, there's a lot more travel vehicularly or air travel that's required to get from market to market. And the areas in the East Coast that have been, I think, in favor are essentially areas that have had pretty good economic growth. Whether it's North and South Carolina, Georgia, Florida. If you get into more interior areas like Alabama or Virginia, West Virginia, I think you'll have success in any of those places. The East Coast, historically, you think was Boston to Washington, D.C., and that's where it ended. I think that's changed. It's still a small, relatively speaking, a small amount of our portfolio, but it's become a little bit more important in recent years as we've done new acquisitions.
Okay. So are there any particular areas that you think offer better valuation than others at the moment?
I think you're going to be paying up for these places now. They used to be more bargain oriented, and now they're more just pay what you have to pay to own it. The cap rate differential between New York and other places has narrowed considerably. In some instances, you might even be paying a richer valuation out of New York than you're paying in New York as far as cap rates. So, in the Sun Belt areas of the East Coast, like Florida, Georgia, the Carolinas, to buy a quality residential property, you might be at a 5 to 5.5 cap, whereas in New York, you might be at a 6 to 6.5 cap, to 7 cap, even if there's rent stabilization involved.
Right.
But if your property is on the East Coast in a market that's recognized as potential for growth, things have flipped from where they were 15, 20 years ago. When I was growing up in the real estate business, they would say there's New York City and everywhere else in the real estate world. And now I would say that things have changed a little bit. You can get good value, good real estate anywhere, really. And if you're open to exploring new areas, making new relationships, learning new places and statistics, and we're willing to take a little bit of a chance, there are things you can do that are a little bit different and actually might complement your portfolio in New York City. You could perhaps hedge your bets on what's going to happen politically in the world by buying in different markets. There are things you can do to offset the issues with the political environment in New York. And the other world outside of New York for residential and retail might just offer you a slightly different kind of a property to work on. Maybe it's more of a value add type of a play, whereas in New York you're buying more core. It's difficult to really add value in New York sometimes because the rules don't allow you to raise the rents all that much.
Right.
So you're buying very core properties, or you're just buying a development, something you knock down and build something new. Whereas outside of New York, it's very rare that you'll ever knock anything down. You're really buying something to renovate it. And it's also pretty rare where there's no value to be created. There's very little that's brand new, and you're buying stuff that's 15, 20, 30 years old. Not as old as stuff in New York, but not as new as a new development would be.
Okay. And similarly, are there requirements of the ultimate buyers of these or renters of these properties for higher amenities? Is that easier to do outside of New York also?
I think New York actually demands a more robust amenity package in a newer property than you might have to provide outside. But again, if you're buying a garden apartment style development outside of New York, the amenities are pretty much baked in. there's very little you could do to really increase the amount of amenities. But what you can do is you can improve the amenities that are there. You could renovate those amenities. You can put in, you could rip out something which may be there. Like in one instance, we had a tennis court on a property. We ripped it out and created a grilling area and a dog park and a tot lot / kids playground area. You could put a lot into where a tennis court used to be. There are things you could do with a gym that were not being done 10 to 20 years ago, as far as equipment, as far as interactive pieces of equipment like a mirror.
Oh yeah, and the
or
screens they put on the
or
walls and all that stuff.
there are all kinds of things you could do. So you bring a little bit of a different perspective maybe than somebody else might bring, and it allows you to create value. So it's still real estate, though. At the end of the day, you still have to collect the rent, you still have to have good tenants, and you still have to run the building properly and respond very quickly to any kind of an issue.
Okay. So in this region where we've talked about, there's been this decline in the margin between cap rates, or the difference between the cap rates, I should say. And we're talking about limits on on different types of incentives that you can put in there. How do investors in this sector get diversification in the region, or is it just the political diversification you mentioned before, or are there other things that you can get across the region?
Well, I think you're getting more certainty in your renter profile with multifamily. You're perhaps achieving a little bit of a different kind of a property than you have in New York. I think in New York you're much more reliant upon affluent renters in a lot of these situations. In outside of New York, you're talking about a very middle income, tighter band of assets and renter profile.
Okay.
You're not looking, in New York, you could have a building that has a billionaire and a person struggling month to month to get by. It's really incredible what goes on in some of these buildings.
That's the building I live in. Yeah.
Yeah. You might have, right. So you might have somebody living at the top who can afford anything they want, but this particular apartment was convenient. It spoke to them. They have family members around, whatever. And then you get people in the building who are either rent stabilized or just in a less expensive apartment. And they'll be interacting with one another, and it's perfectly normal.
Right.
You go to a place like North Carolina or Alabama or Florida, and if you're in a garden style community, the rent band is going to be between $1,000 and $1,500 a month for a 2 to 3 bedroom, and it's a very similar profile of folks who are buying or who are renting actually there, and who have a pretty narrow band of the income, and it's not really going to change. Somebody who has a tremendous amount of resources is probably going to buy a house in that situation. Right. In New York, you have a lot of rent by choice types of people who are like, hey, I have my assets in investments and various types of things, my business or within a stock portfolio or something else, and they're choosing to rent as a financial decision. Right. I think outside of New York, it's a little bit different. People are maybe choosing to rent because they don't know exactly where they're going to live in 3 to 5 years, or they're single and it's not going to change. But if you have a family and you have the means or the resources in a place outside of New York, you're probably going to try to buy a house. And that's just sort of what we found. And you're not going to lure somebody. You could create a gold-plated penthouse with all the goods, all the bells and whistles. But what you're not going to really achieve is bringing in somebody who's like the CEO of a Fortune 500 company into the rental community, even no matter how nice it is, because they're going to buy a house. So it's a little bit of a different dynamic. You have to be cognizant of the differences and treat each property different.
Okay. That is interesting from a diversification perspective. Looking forward, one of the things that all these regions have in common is a massive increase in expenses of building. In various other expenses along the way, even before you move in or after you move in. So, how do you forecast that going forward for investors? Do you think this is a long run thing that's going to keep the market propped up, prices propped up, or do you think how are you forecasting all that?
Well, I don't think we're going backwards in terms of construction costs. I don't think that's going to change. Construction is never going to get cheaper. It's just inflation continues for raw materials, labor. The financing costs have gone up. So in that area, it's going to become harder. It's always going to be a little harder every year to build. What I think might change in coming years is regulatory environment. whether land will be cheaper to acquire, whether municipalities will upzone properties, especially if they're near mass transit. And I think that that's actually becoming, in a positive way, a turnaround issue. The term YIMBY, which has now become really mainstream, yes, in my backyard, as opposed to NIM. We've all grown up with NIMBY, not in my backyard. There's actually a really strong cohort of people who are actively lobbying in favor of more housing and opening up areas to development and to zoning that would have been unheard of 15 to 20 years ago. And opening up, obviously, zoning and land and air to more multi-story, or high-rise or mid-rise types of properties is something that you're seeing in New Jersey, you're seeing it in Connecticut, you're seeing it in the Southeast, tremendous numbers, especially in areas like Fort Lauderdale, Miami. So that's something that's definitely helping, because that air is free, as I've always said. If you could just change the zoning and allow people to go up 6 stories or 12 stories instead of 3 or 4 stories in the same piece of plot of land, you're going to get double, triple the amount of units. So that's going to help make housing more affordable. Part of the issue in New York is we haven't gotten the YIMBY memo yet. Not quite. Mayor Bloomberg did, in his credit, upzone a tremendous amount of property. I think Mayor de Blasio tried and did some, but not as much. And I think Mayor Adams has been really preoccupied by public safety and all the other issues with migrants coming in, and all the other. To his credit, he's been working on City of Yes. They have tried. The state legislature has tried with 485X to replace 421A, even though most people would argue that's really a poor substitute. But at least something was passed. The question, as we toggle back between New York and the Southeast, will New York be able to match the dynamism of other markets in terms of upzoning and allowing people to build? I know folks who work at public companies who are pivoting to New Jersey over New York because New Jersey has much less centralized zoning mechanisms. It's often town to town, county to county, whereas New York City has a city planning commission and there's really one zoning, and it's a lot more difficult to change zoning necessarily in New York. You can do it, ULURPs are done, but the idea of building certain types of housing is harder. Certainly without the tax abatement that we had when the 421A program was in place. So if you go to the Southeast, there are certain markets where it's really hard to build, difficult, and certain markets where it's much more user friendly for a developer to come in. I would argue that because these areas are so big, you could always find a place where you can build. And as a result, I think you're going to see a lot of supply being delivered in the next year or two. The issue really is in 3 years, 4 years, 5 years from now, as we've gotten more used to a much more restrictive financing environment, will the supply continue to come through? Will the pipeline keep producing more housing in the next 3 to 5 years? We know in the next 1 to 2 years there's a lot coming on the market, and that might be a little bit of a relief valve to pricing, both for rent and sale housing. The question is just how long can that continue? And will the financing world, the fact that interest rates have essentially doubled, and not just that, but the amount of equity being required by construction lenders has gone from, say, 30% to 50%.
Right, bigger than the rates is the underwriting.
It's a big problem because if you're trying to put together the money for a deal and you can get 70% from a traditional lender, you have a gap of 30%. Now you have a gap of 50%, and that extra 20% is going to require a lot more of an interest rate than the traditional lender.
Right,
because they're in a position of danger in the capital stack.
Right, and perhaps other terms and conditions beyond just a higher rate, right? That's the
guarantees, other things. Yeah.
I want to talk a little bit about your perspective on the lending market because I think you have a good one. But before we get there, I just wanted to back up for 1 second. So you talked about regulatory and you talked mostly about zoning and land use. Do you think there are other regulatory changes coming that will change some of these dynamics, or is that mainly what you were talking about? Is zoning and usage?
Such as environmental.
Yeah, anything.
I mean, there are all kinds of things that are always under discussion. Elections come and go every 2 years, 4 years. So you can argue that with the red wave, it's possible that the regulatory environment will become more relaxed. But then, you plan for that. And then in 4 years, you could have a new president, a new Congress, and then all of a sudden you bought land and you're hoping that something's going to happen and it doesn't happen. Or the political environment changes and you get whipsawed back. It's hard to know. Historically, local land use has won the day. Mm-hmm. So in terms of zoning, you could be more sure. In terms of other things that are more federally mandated, it's harder to plan and you just hope for the best. So I couldn't tell you for sure, but usually these things do change.
Yeah, over time. All right, so let's talk about lending for a second, because this is underpinning a whole lot of things, right? So the lending market is definitely evolving. Where do you see the risks in this sort of new normal, in addition to rates? Anything. So anything that you're working on. So all types of residential. Let's take it there.
Well, I mean, the biggest risk to the market right now is actually refinancing loans that are already on the books.
Right.
So I think we should start there. And it's not just residential. It's office, it's retail, it's hotels, it's all kinds of uses. You have billions and billions of dollars turning over every few months that need to be repaid. And you very often have a lender that's the existing lender that won't renew the loan no matter what. They just have to get the loans off their books. So what that does is it produces a tremendous amount of dollars that need to be now paid back, and you have to find lenders to replace all these loans, and there really aren't enough lenders, at least traditional lenders, to replace the avalanche of loans that are expiring all the time. So what happens? You're getting alternate lenders, people who you never thought of as a lender, who are now all of a sudden lenders because they feel like they can come in and take advantage of the situation in terms of getting better returns. They could take a point or 2 points up front, a couple of points on the back, have a loan out for 2 years, take your point or 2 points, have the loan. They're going to lend at 50% loan to value, 60% at most. Right. They're going to get a 9, 10, 11, who knows, whatever the return is on the first loan. They're also going to basically get a pre-packaged kind of a deal where if you default, you can't really hold them up as much as you would if it were a typical loan. So all kinds of things happening. Right. And I think that until the market works through this avalanche of loans that are coming up, it'll be a little bit more challenging. We're finding that relationship loans are the best way to go. Folks that we've done business with and know us, and that's really great. There are certain situations where you're going to just find yourself paying more money. That's as simple as that. It comes down to what rate were you paying and what rate will you be paying. I do think there's a chance in the next 2 years where that all dies down, inflation comes down, 10-year Treasury would come down a little bit. The SOFR, benchmark rates come down and the spreads tighten. That could happen, but it may take a while.
Yeah, I mean, all of those things, sure. You could see Fed and SOFR coming down sooner than later. Like they already are. I mean, it sounds like, I'm not looking into a crystal ball here. They are. But those other things you mentioned, they could be a little trickier.
Right.
Well, so one thing that I do want to ask you about was an excellent piece you wrote that's available on your website, that we'll put a link to it in the show notes here, about what New York City investors, et cetera, everyone else in the market can learn from the development of the New York Marriott at the Brooklyn Bridge. So could you take people through the highlights of what you wrote and just talk about what we can learn from that? And I encourage everyone who's listening to this podcast to give it a read, because it's really interesting.
Well, we were in a challenging environment at the time. The city of New York hadn't had a hotel built in Brooklyn in 40, 50 years. And the city was really adamant that as part of our Brooklyn Renaissance Plaza development, that a hotel would be included. And since we were leasing city property and we were doing the deal with the Economic Development Corp, it made sense for us to figure out a way to get the hotel built. It was helpful that we were able to do an anchor tenant deal with the Brooklyn District Attorney's Office for a significant chunk of the office portion of the property, but that wasn't enough to get the hotel built. We needed a flag, we needed a plan, we needed a viable way to get it done from a construction perspective. So after approaching a number of flags, a number of different hotel companies over a period of years, many of which showed interest, but then backed out for whatever reason. Nobody really wants to ever be the first to jump into a market. We finally, after years of efforts, were able to secure Marriott to flag the hotel, create a full-service hotel in Brooklyn. It's steps off the Brooklyn Bridge, right near every piece of mass transit you can imagine. Yes. Between trains, subways, buses. You could walk to Manhattan if you need to, which has happened over the years because of various problems that have occurred. Getting Marriott on board was really a final step towards getting that property developed. It was sometimes you have to create a path where none exists, and in that situation, we really needed the hotel to get built because it was a significant part of the overall development. Without the hotel, we never would have been able to complete the 1 million square foot office building that to this day is fully occupied and has been a great asset. Without the hotel, that never happens. So after enough kind of cajoling and working through the issues with the leadership of Josh Muss at the time, was fully leading the charge as far as getting that done. It happened. It was a great accomplishment for Brooklyn, for Muss Development, and I think for the city in general, because what happened after that was once the hotel was successful and approved concept, you had dozens of other hotels being built, both in Brooklyn and in Lower Manhattan and Queens. And it really led the way towards a resurgence in the hotel market, and arguably the resurgence in tourism that we saw starting in the Bloomberg administration.
Right.
Without all these new hotels giving people a place to stay, a comfortable place to stay, it might have been more difficult for New York City to achieve the heights of I don't know the exact numbers. It's 60 million people a year that come visit New York City.
Yeah,
something like that.
60 million
60 to
visitors,
65
as they call
visitors.
it. Yeah.
So that's an astounding number. I mean, I would say very few cities in the world can match that. And New York City historically was really known as a financial capital and all these other things, but tourism is a very important cog in what makes New York great. And without new hotels, it's hard to justify a lot of people coming in.
Yeah, I think this was exceptionally interesting for a few reasons. One is it was a win in a sort of public-private relationship that we don't have a whole lot of in New York, and might provide a playbook for other industries. The other reason I thought it was interesting is as a homeowner in New York City, I'm well aware at the time Airbnb and some of those other things were growing quickly. Those relationships are illegal in New York City. So that would have created, without the offering of more hotels at relatively cheaper rates because they weren't in Manhattan, took some stress off of that. And, for people who are owners, people like me who are on boards of buildings, it was a major headache reducer. And then the other thing that I think makes it exceptionally interesting is it shows you the power of the transportation network, because it is right on about half the subway lines in the city. And, that mix of those things, I believe, is a very compelling way forward. Now, obviously things have changed since then a little bit, but things always change a little bit. But I do recommend everybody's listening to the podcast, get a look at this, because this is an interesting playbook. Even though it happened a while ago and seems to lack some level of urgency, it is a playbook. Perhaps we can leave it there and get you a few more eyeballs for the work you've already done. And thank you for being here, Jason.
My pleasure. Great having this discussion with you, and I hope everybody finds it informative.
And thank you all for listening into this podcast. Until next time, this has been Compound Insights, and I'm your host, Rob Rowan.